Putting some of them in.
There we go. We have started. It's recording.
Perfect.
Who says we can't figure out this technology?
Yeah, this technology stuff works great.
Why don't you speak for yourself?
Well, welcome everybody to our, we've done quite a few of these beers in the backs, but this is our first live version. So we are, I would say, building the airplane as we're flying, trying to figure out the technology. We've also, our esteemed guest, Bill Lapp, is running late. I wonder if his battery power in his Tesla is not working quite.
It's a little cold today.
It's a little cold today. Maybe
he had to stop and recharge somewhere, maybe.
Yeah, something like that. So, at any rate, I think what the topic, we thought we'd do one of these at the end of the year to kind of wrap up 2024, talk about what happened, because I was taught a long time ago in the commodity business, you're not looking in the rearview mirror. You can't hardly look out the windshield. You got to have that history as your guide and as your reference point. And I think we'll probably let's just start there. Nate, you got us kind of a list here of what different commodities have done this year, kind of a high and low and where we're at this point. The first one on the list, soybeans. And just give you rough numbers here. We didn't quite get to $13 on beans, but stopped about 10 or 11 cents short of that on the high side. The low, we've been down on the front end of this market as low as about $9.36. And we are only about 30 or 40 cents off the bottom of that right now. So soybeans currently close to the bottom of the range that they've been in.
But look at that one. So Dave, the high of 12.89 was on January 1st of 2024. So
pretty much
we put in the high, kind of the first trade of the year, and it's been nothing but lower since then.
Yeah, so the bean market, if you were actually charting that, looks a bit like a ski slope. You know, kind of a good bit less volatility in the corn market. Now, you got to be some of the when we look at the highs and the lows here, some of the lows when you get into the delivery mechanism, they get a little bit distorted. Shows a low of the corn market at 360. The high of the corn market about $1.10 higher than that, $1.13 higher than that at 473. And we're at 446 right now. So the corn market, not at the top of the range, but a heck of a lot closer to the top of the range than really some of these other markets. Soybean meal is another chart that probably looks a lot like the soybean chart. We got a high of 391. Nate, you can tell me if I'm wrong here, but I would suspect that was probably pretty earlier in the year, just like beans was.
Yep.
We have been down more than $100 below that, just under $280 for a low. Currently sitting at about 295. So when you look at the wheat market, that one's had quite the little range here too. We've been stuck our head below $5 by just a wee little bit on the front end of the market. The high has been about 720, and we're currently sitting about 734, 735 area. So certainly not at the bottom, but pretty close to it. And
right.
I think when you start looking in the rearview mirror, there's a lot of different things that have caused this, and I think we'll probably maybe just start here with the soy complex.
I think Bill just showed up.
Yeah,
he did.
I heard something with the door.
We can see him can you see him?
Yeah,
through the door there.
Yeah.
I think when you look at the soy complex, I think the thing that has really dominated that from the beginning of it is really the soybean market itself. We've had record production. Well, welcome, Bill. We were just joking about whether maybe your Tesla wouldn't go over 30 miles an hour in this cold weather. We talked about kind of the highs and lows and where these markets have been, soy complex, wheat, corn. And, soybeans certainly look to be, that market's kind of been generally in a downtrend the whole year. The high was just under $13, set that January 1st, basically, the first trading day a year ago. And I think the reason that the soy complex has been under pressure, as the old joke goes, there's two reasons for it: supply and demand.
And demand.
On the supply side, we've had record crops. Had a record crop in South America last year, a record or very damn close to a record crop here this year. We'll see what USDA says on January 12th, I guess, when they give us their final. And we are not done yet by a long stretch, but we are what looks like on our way to maybe the mother of all record crops in South America. So where are you seeing South America stand at this point as far as crop size and what the USDA says and what the market says?
Very good weather. Very good weather so far. So I guess maybe the risk is that we go the other direction from here. I mean, we might come back after January 1st and actually find some problems down there, but so far we've had almost none. And that's pretty uncommon that you don't find some time where you have hiccups.
It was told a long time ago in this business that statistically, you only have a drought, a weather-related production problem 1 year out of 8. But about 7 years out of 8, the market at some point during the growing season will think it has a weather problem.
Yeah,
so
almost every year.
And we really, to your point, really haven't had that in South America yet. I mean,
outside of the late start.
Yeah, a little bit of a late start. I mean, we were kind of had our hand hovering over the panic button about that late start, and then all of a sudden the rainy season got here and life was good, and we pretty much got the bean crop in generally on time. Maybe the front of it was a little bit late, but we were caught up and then some by the time we got it planted. Brazil weather has been, I would say at this point, I hate to use the word perfect, but
outstanding.
Pretty close to perfect. I think in Argentina, one of the things that we've started to hear here in recent weeks is, we've had really good rains in Argentina for the last 2.5 months or so. But really they haven't been heavy enough and widespread enough to really fully recharge the subsoil moisture. And so we do need to continue to get these timely rains in Argentina. We got about 2/3 of the crop in the ground down there. But we're going to need to get those regular deposits into the checking account, as we like to refer to it, because we don't have a lot of subsoil moisture to fall back on. Looked like, and this was really a big topic coming out of last week into this week, was that, we got a couple of weeks of not a lot of rain in Argentina. Is this the beginning of the, a bit of a dry spell? Some of the forecasters were calling for that. But then if you've noticed, especially the 7-day forecast in Argentina, we have that in our daily wire. Every day this week, it looks like there's better rain chances in the growing areas in Argentina. So, way too early to really talk about a problem down there, but the market's starting to.
Yeah, you're only 2/3 planted down there.
Mm-hmm.
And so it would seem that you're going to have enough decent weather to get completely planted and maybe get the crop off to a halfway decent start. From there, who knows? Yeah, I mean, in Argentina, it's kind of like May here. When you get in central Brazil, it's kind of like August, late August. Yeah. I mean, they will start to be harvesting soybeans in earnest in less than a month. They're already kind of starting a little bit, but I mean, it's really, really a slow start down there. So,
hey, I would just real quick, if anybody has any questions, since we're doing this with people on here, if you have questions, just throw them in the chat thing, I guess is how that works. And we'll catch those. So if you have questions, just throw them out there.
Yeah, a great call out, Nate. That's one of the reasons for doing this live is just to try to get this where it's a bit more interactive rather than us just sitting here yakking and drinking. So we probably shouldn't get too far off into the year to come yet until we get to the year in review. What else do you think are some things that kind of define 2024 that are going to be considerations as we go out here into 2025?
You're posing that to me, and that's a difficult question. The election obviously has consequences, as they say, and at least the threat of tariffs has got us frazzled up. It's hard to look back more than a month or 2 months even to say what defined 2024 when you review it. And
to me, I think one of the things is just, you look at the soy industry, and all the soy crush. And again, it wasn't just this year, but this was kind of one of the big years that we did add quite a bit of new crush, and not just crush, but also we added some refining capacity with that plant up in North Dakota, some more crush coming online as we get into 2025. And I think we've been talking the last, 3 or 4 years now about this looming wave of meal production that's going to hit the market. And where is all the soybean meal going to go? And I don't think we really felt it until probably the last month or two
Yeah.
And all of a sudden you see what meal values did. So to me, that's one of the big things this last growing season or this last calendar year that's been really kind of impactful to the market is something that we really haven't seen before is we're adding new crush capacity to fill an oil demand and really trying to figure out where is all this meal going to go. And I think prior to this, and I think Bill, you had talked about it, we were able to export more meal because Argentina was really dealing with some struggles, either with short crops or whatever. But now we're going into a period where they've had a good production. Their crush rates are picking up. So now the question comes, is the U.S. going to be able to compete for that export business going forward?
Somebody will have to, or otherwise we'll be using soybean meal to build the Minnesota Golden Gophers a new football stadium.
That's right.
I think that your question was what happened. We had almost North American good weather. We had a record corn yield by somewhere, we'll get the final of this, a record yield by 6 bushels per acre above the previous. Probably not repeatable. Spring wheat had yields also 6 bushels above the previous record, almost 15%.
Wow.
So you had very good weather there. And other than the end of the year, soybeans looked good too. And we'll see what the final report says on January 12th. We may get some shrinkage there, but we had very, very good weather with regard to yields this year and showed what we can do. And you could make an argument with these good yields and rebuilding some stocks. Maybe we've found what our low end of the range is going to be for a while, and especially in corn.
Yeah. Yeah, I think that's, I've been doing this for a long time, as have you. And all of the big markets with the big price run-ups always have a demand component to them. But most of the big ones have always, they're kind of closely associated with a supply problem because generally Mother Nature gets a little bit cranky. And I hate to even say this out loud, but we really haven't had a big one of those in a while. We had not last crop in Argentina, but the crop before was a disaster. I certainly had a little bit of a crop problem last year with the leaf hoppers, less to do with weather than that issue that they had in Argentina. And then you had a Brazilian safrinha corn crop failure, but that's 3.5 years in the rearview mirror now. So knock on wood, we've had, we've strung a few production cycles together and been in pretty good shape. And I think that was kind of our counsel a year ago at this time is, it looks like the stars are aligning where, Mother Nature stays kind. We could be getting some of these, what had been some pretty severe supply tightness in a lot of markets. Certainly the corn market was that way. If you looked at that a year ago, we were coming out of a couple years of pretty tight corn supplies. We've had
2 years ago on wheat.
2 years ago in wheat, and then certainly been dealing with this war in the Ukraine. And I know you want to talk a little bit more about that today, but that has not exactly panned out the way I thought it would a few years ago when it started. What did it start? Be 3 years in February?
February 22.
There you go.
I got to be honest. It's made me scratch my head, this recent price action. Maybe Bill too. He scratched all the hair off of his head. I can't honestly make heads or tails of it. The fundamentals would tell you today that we ought to be priced higher than we are. I think our U.S. futures anyway. We keep getting what seems to be worse information out of Russia.
That's just dryness they're causing that.
Dryness. They were dry. One of our big analysts over there that we follow has cut their estimates now, I think, for the third time, and they're below 80 million tons.
What was that crop last year?
85 and change. 85. The 2 years ago was the big one.
Over 90.
They had. Yeah. So there's that. The Russian government has come out and put a pretty stemmy quota on for the balance of their trade year. Now that starts middle of February and runs through June, and that's only 11 million tons. In fact, I think they might have lowered that again to like 10.7 or something. So the implication you might think is, well, where's the world going to get all the rest of this wheat that they need?
Well, they're going to come here and prices are going to go up and everybody will be happy, but the price ain't going up.
And USDA raised their exports on the December WASD. I don't know if they're going to go up again. Just this past week, I mentioned on our weekly call, Saudi Arabia was in, and they were in for quite a bit more than they originally were going to get. It sent the Paris exchange to 7-week highs, and we didn't do a damn thing.
Chicago.
In fact, we went down.
Chicago kind of went.
We've got new contract lows in Chicago in the March and the May and the forwards. So I don't know. I would expect that there's probably a bounce in here somewhere. Don't know how far. I can't imagine that we're going to keep running this thing lower. The funds are in there. I did kind of confirm that today. We'll probably see the CFTC report today show Chicago funds with maybe 75 or 80,000 short, which isn't huge in history, but that's certainly shorter than they have been.
You wonder if it isn't the spec that's been interesting to see here in a little bit, the commitment of traders report this week, because it does sure seem like this week the market has been awfully weak in the face of what many times in our long and storied history has been a bullish price move. There's a lot of information out there that you would expect would move the market the other way, and yet it just seems like every time you look at it, it's got red numbers by it. So it'd be interesting to see where that goes. I think as we shift gears here and then start, looking out into the future, you had talked about tariffs. Heard you have a direct line to the new Trump administration. You're going to tell us all the tariffs that are going to go in place on January 21st.
Aren't you going to Mar-a-Lago next week for Christmas?
Not again.
Oh,
not again. So yeah, I mean, there have already been changes. We do a lot in the veg oil market, and we have already seen customers change buying patterns, what they're going to buy, what oil, where they're going to get it from, because of and I don't think it's any more than a tweet. It's actually on Truth Social. What do we call a tweet on Truth Social?
Yeah,
I don't know. But this threat of 25% tariffs on day one with Canada and Mexico if they don't help us with this immigration and drug issue. So what do we do with that information? I don't think most people think it's going to happen, but you can't actually not do some contingency planning, especially if you work for a big corporation. So,
well, the history tells us, I'll just dive into it at first, that we have 4 years ago in 2018 or whatever that was, a little longer than that, 7 years ago. In 2018, we had tariffs, but it took a year before they would come into place. So the Trump administration back then started, it took a year, and then they just absolutely nailed solar panels and washing machines, just devastated that industry. But the rest of it didn't come for a while. So it was a year it took. It was narrower than a total across the board implication where it hit everything. And eventually they retaliated on soybeans, and we had a sharp drop, several hundred million bushels in exports. I think you're going to see somewhat of a replay of that, where it won't be as draconian as was originally stated. I think one thing.
You suggesting it was a negotiating threat?
Well, I think that, yeah, it was complying with some campaign promises made. There's probably some things that the president of Mexico and prime minister of Canada have in their pocket that they can say they did, and then everybody can claim a victory at the end, and nobody goes home without with the most severe of the tariffs put into place. So I think ultimately, whether it's negotiating, it just won't happen. I think that there's a risk of creating more inflation by some of the tariffs we're talking about, and immigration policy as well. And that's kind of a red flag for this administration. They don't want to make the same mistake the last one did and impose more inflation on consumers. So I think there, in a year there will be some. Will they be as severe as we said? No. Will they cover everything? No. China is kind of the the poster child for countries. They're probably going to want to do something to penalize in the past. So we'll get some, but I don't think they'll be nearly as severe. The question mark becomes, there's going to be an effort to extend the tax cuts that were made in 2018. And they expire at the end of 2025. And so the thought was previously that you would pay for them through tariffs. And I don't think it wasn't going to cover the entire cost of them anyway. And I don't think this would either.
Yeah. I'll tell you what, it's a whole nother 2-beer discussion to talk about the whole pay for the tax cuts, because if you actually look at the government data, the tax cuts gave us more revenue. The tax cut, the cuts in tax rates gave us more revenue. So I guess only in Washington, D.C. is that somehow seen as less and something we have to pay for. But that, like I said, that's probably.
Well, if we have deficits, which we do, which are larger than before, we have to do something about. And
yeah.
And we haven't really tackled those. Those will become a big part, and that's kind of the big part of this kerfluffle we've got going on in Washington, D.C. as we speak right now. So
they're going to get this figured out. Or are we shutting her down and going home for Christmas?
And well, that's a 26 issue. Probably. It's going to take a while.
No, I mean with this current bill, I don't guess we're on here to
The
talk
CR.
about the current.
I thought I saw something that said that they passed something, but maybe
Well, what
Maybe
I
it's-
read just
maybe it's
before
fake news.
what I just read before I picked up my last call was that they had succeeded in at least splitting everything apart.
No.
And so they were going to vote on individual bills
Wow.
going forward, about 4 or 5 different individual bills. Now, I hadn't
Huh.
seen anything since then, but I haven't been
Yeah.
back at it.
That could change by the time this calls in.
Oh, sure.
Yeah,
Oh,
no
sure.
doubt.
Call-ins.
We got a big report coming up in early January. Final crop, Jan 1 stocks. We get our January WASD. If they can get
Acres.
this
Don't forget acres. You always forget acres.
acres on, oh yeah,
See
yeah,
how he
for the
does
stuff
that?
I don't care about wheat.
He doesn't care about wheat. No.
Yeah. So I guess if they shut this down, we don't get that report, do we? That is.
Well, we did that in October of 2013, where we just canceled the report and went on to the next. They would issue it, and it probably would come when the government reopened. A bigger issue that, if you want to be scared of something, is if we allow the farm bill to expire, and then we revert back to what's called permanent legislation. And that will start, we don't have a farm bill now because it expired in September 30th, 2024.
Well, actually, it expired a year before that. But
And
then
we got an extension.
yeah.
We have one right now. It was extended a year. So we're through September 30th, 2024, we had a farm bill.
okay.
It was extended from the previous one. And now we don't have one. And so you revert to permanent law, 1949 or 1933, depending on what facets of it. When the first marketing year starts for the first crop, and that would be dairy products. So you would revert back to something called parity prices, which for milk it would guarantee the farmer $66 a hundredweight for milk, which is more than triple where we are now. And the government would be obligated in implementing that to buy surpluses till the price got up to that level. So there's a pretty big pretty big issue there if you don't get it. So everybody wants there to be a farm bill, and there will be, I think. I mean, you just don't let this. The less draconian part of that is that the new Secretary of Agriculture, or on January 1, the acting Secretary of Agriculture can drag their feet on this. So we don't have to, on day one, go to $66 a hundredweight for milk, but they can drag their feet on that. But that's kind of the impetus for doing this. We've had this for over 50 years. hyper-parasitical relationship between the people who want more for farm stamps and the more people who want another 10 trillion or whatever the farmers are getting.
Yeah,
10 billion. Sorry.
So yeah, we had a trivia question. I think we did on our key market drivers, and I'm not sure if you gave us the answer or not. But I was actually shocked. The percentage of the money, the spending in the farm bill, what we call the farm bill, that is SNAP payment or food assistance, was like 81%.
Yeah.
Which shocks me. I wouldn't have guessed it would have been anywhere near that big. So
I think there's a lot more millionaires on the farmer side that are getting a lot of money than there are on getting food stamps.
Probably so, but a lot more money spent on the food stamp side.
Mhm.
So let's, I guess, switch gears here a little bit. I would say that this change in administration has been or is likely to be more disruptive for commodity prices, because that's what we're here to talk about. It's not politics, it's commodity prices. Really, than we've probably seen in a while. And part of it's the tariffs that you discussed. That's, we've already been through that a bit. If you got any more to add, great. But we've also got this biofuels thing. Now, we've always got a biofuels policy, but there's a couple, I think, nuances here, probably 3 of them at least, probably 4. When you look at the biofuels policy, that are variables that could push commodity prices around, especially veg oil prices. And they could go different directions depending on what happens. And the first one is the current mandates, the RVOs, expire at the end of 25. So at some point relatively early on here, at least if they're keeping to their own schedule, they'll have to propose mandates for where does this program go from here. So that's part of it. It's probably the last part we'll have to deal with. I noticed you had on the sheet here, and I think it's a great topic, is UCO imports. So the farmers ain't happy because we got this biofuel policy that is a de facto farm support policy in addition. And we're supposed to be all this demand for vegetable oils, soybean oil in particular, that we're going to make renewable fuel out of, and life is going to be good, and the earth is going to be green, and everybody's going to be happy. Except we're fulfilling a lot of this feedstock requirement is used cooking oil that's coming in from other parts of the planet. Now you may be listening to this.
But are we really fulfilling our obligation with UCO, or are we bringing in UCO and filling somebody else's obligation?
Let's
go through the last 2.
Yeah. So I think that the other parts of this is when you look at what the prior administration did with the small refinery exemptions. So I've had people that I talk to in the industry that are, some of them involved in the lobbying effort, say, well, the Trump administration might be a little bit more friendly to, larger growth in the mandates. Well, that's probably bullish feedstock prices. But Trump 1.0 kind of handed small refinery exemptions out, which is a de facto reduction of the mandate, like they were Kit Kat bars at Halloween. So you got those issues to deal with. So, I mean, the biofuels thing to me is kind of the wild, wild west right now.
Well, I think one thing you can say about 2025, we'll all have limitations on how much information we can absorb and digest and use. So there's a couple things in there that I think are less impactful. I think that the new EPA administrator will come in, and the EPA will be obligated to do something with the RVOs. They set them. It's not any Congress schedule. It's them. And I think since it's pretty much a low cost item, and it is important to Midwest farmers and congressmen,
the tax credits,
they'll keep them in. You said the RVOs. We're talking about the RVOs here now. The UCO imports, I think there's a 50-50 shot that we do some restriction, just if nothing else to penalize China. So we'll do something with that, I think, one way or the other. I think you would envision this administration having a closer relationship to oil companies. So to hand out those exemptions again probably is a likelihood. And I think that anytime you spend over the next year or 2 years, worrying about biodiesel tax credits and 45Z is time you could have spent doing something more productive. I think it has to
Well
be
said.
it has to be upped again legislatively in 2 years, and I just don't see it. It's a pretty expensive program. I don't see.
That's the RFS.
This is the tax credit.
He's talking about the 45Z tax
This is
credit.
the
Oh, okay,
tax credits.
okay.
You can, if you turn off your headset when somebody says 45Z, I don't think you'll miss anything for the next year. That's one person's opinion.
Yeah. Well, and but I think, I don't disagree with anything you said, but I will say this. If you're a veg oil buyer right now, the fact that the current $1 a gallon tax credit is expiring is, I would argue, causing some pretty significant market disruptions, because it just feels like, and I think the cash market's telling us this is exactly what's happening. We're transitioning from this calendar quarter that we're just finishing up, where demand for veg oil in the US has been outstanding. Food demand is always the best it's going to be for the year in Q4 because it's the holidays and we all eat too much. Renewable fuel demand is better than it normally is. It's usually good in Q4, but it's better than it normally is because we haven't known this quarter, and you get $1 a gallon if you make and blend a gallon of it. We don't know what the tax credit's going to be, so we're probably got better fuel demand relatively in calendar Q4 and less relatively in Q1. And we got an export program that's running hard right now for soybean oil. Mm-hmm. Now, that program looks like it's going to continue out into calendar Q1, by far the smallest demand component. According to the USDA, we're going to eat 14 billion pounds of soybean oil. We're going to burn 14 billion pounds of soybean oil. And we're going to export a little over 1. So it's not a huge part, but all 3 demand components are running hard now. We talked about the South American crop. If the weather stays good in Argentina, they're the biggest competition we have exporting meal and oil. Is that going to get difficult? And I think we've got a larger than normal maybe swing in demand coming at us between Q4 and Q1. And I think that's what the cash market's telling us. I think that's what crush margins are telling us. Because crush margins are getting crushed, I guess, if you let me allow that pun, but right now. So I think it is important, but I think what history has told us when we've had an expiring tax credit is that it's probably important in the demand structure between the end of this calendar year and the beginning of next. But the reality is what we've seen in the past is we still have mandates we got to do, RVOs. And so the industry at some point, you can run faster this quarter and slower next quarter, but you got to fire the equipment back up because we have a mandate to meet. And so might cause some market volatility. I'm not sure it changes the endpoint, but yeah, might cause some pretty significant market volatility. So I guess we're 35 minutes in here. I don't know that we intended to go quite this long. So let's kind of move it to maybe a little bit of the predicting the future stage. I think the next thing that we're going to be talking about as we get out into Q1 is we got this big acreage report that we will get from USDA, kerfuffle. What would be your best guess based on what you can see today on kind of that U.S. acreage mix, corn, beans?
So I wrote my notes here. The prices certainly would suggest more corn, I think, right now, but the input costs for farmers who are under financial pressure would be greater for corn. So I think we'll get more corn, but not a dramatic amount. 92 to 93 million corn and 84 to 85 soybeans, I think, will be where I would land. And, that there will be enough tightness, especially if we get any kind of reduction in the corn crop, there will be enough tightness going into the spring that'll be enough to get people willing to walk out with a bullish story on corn. So I think we're going to keep these prices supported where we are now. It's, more likely the nearby will trade $4.75 rather than $4 in that scenario.
Certainly seems like corn is a lot less of a bearish scenario than beans might be, especially if we bring this crop into the bin in South America.
Well, I was just going to say, so how long are you talking about that kind of a price handle, assuming we get a nice safrinha crop down south and Argentina's, hold serve.
Well, I would stick with 475 being more likely than $4. I mean, into the summer until we know we've got a crop. This year we made the lows very early, I believe in August. And so we can hold prices up there for a significant period of time, I think, and you could get soybeans very cheap relative to corn. I mean, I think that if you get the worst of the worst scenarios for soybeans, they're below $8, and that won't
below
all
$9 or below $8?
below $9. Sorry, thank you. And so 10%.
You had some people starting to slit their wrist, I think, maybe on the.
they were putting in buy orders. So I think that's possibility. One thing you didn't mention there, and I'll bring it up, is I think that you can bring a pretty bearish story on crude oil into this market. I think in 2025, it's possible. The range from high to low in the nearby contract for NYMEX crude is usually over $20. So we're at $70 now. And I'd say there's more risk to the downside in that going lower than there is upside if we have a $20 range. I mean, just think in your mind, what's your range going to be if it's $20 from where we are today at $70? Is it going to be 70 to 90 or 70 to 50?
Yeah.
And I think it's more biased to the downside.
Yeah, great point. I think, I went back and kind of looked at the calendar year, looked at the front end of this NYMEX crude market, the WTI market, and it's kind of been generally a $65 to $85 market in the last year. And that's your $20 range you're talking about.
Mm-hmm.
But, the question is that $20 split 10 up and 10 down from where we're at now? Is it this way or is it this way? Is what you're asking, right?
Right.
Yeah. I mean, barring a geopolitical issue, which is, I guess, kind of like saying, other than that, Mrs. Lincoln, how did you enjoy the play, right?
Barring a geopolitical event that impacts the markets.
Right.
Thus far, they just haven't had much of an impact.
Yeah.
I think, beef's going to be tight. Feed costs are cheaper. We should get more chicken. That will help benefit that market. We're going to be dealing with high path avian influenza probably throughout the year, both impacting the egg industry as well as now we're starting to see it impact the dairy industry. I don't think the expiration of the farm bill is going to become a reality that you're going to have to worry about $66 a hundredweight milk. I don't think that's a reality, but I think you'll be hearing about it here shortly if we shut down the government over Christmas. I think that like I said, more beef's going to be historically tight. I think there's like at least a 1 in 3 chance that RFK doesn't get into appointed to the Health and Human Services. And even if he does, I don't think he'll be able to implement his revamp of Michelle Obama's food and dietary plans. So I don't think I've answered the question about non-seed oil demand going away, and can we replace it with avocado oil?
No.
The answer is no.
They only made 3 trucks of that this year, and I think they're all spoken for, and then somebody else sold a shorted one. So
go long, fry babies.
Before we get off high path, you did not mention poultry. And the broiler and turkey business. Have we, that was back in 2015 when we had that problem the last time. Have we done a good job of hardening those facilities? And from a regional geographic standpoint, that's not a problem anymore?
With high path?
Yeah.
It's still a problem. I mean, it's pretty bad right now.
But I understand, but we haven't seen it affect the broiler industry.
Oh yeah, their life cycle's too short. I don't think that's much of a risk.
Okay.
We can, you have to take precautions, but typically the life cycle is short enough that you're turning over those facilities quickly enough that you don't impact that from a loss of production.
It's more of an egg and turkey problem, seems like, especially eggs, right?
Primarily eggs, lesser turkey. Now we're certainly starting to see it based on yesterday's milk production report in the dairy sector as well.
That was a shocker. That was a bit of a shocker.
California down over 9.
Yeah, and a lot of that we think was
high path related.
High path avian influenza impacting that sector. So,
well, I'll tell you what, before we kind of just kind of wrap this up, I think as we look into the windshield here, we peer out into 2025 in these different market sectors. Let's talk about the grains and oilseeds to start with. Where are the risks? Where are the bigger risks that we have, both on the bullish side and the bearish side? By the way, it's a two-bear discussion, so I get my figure.
So I think he asked you a question about where the risks lie.
Where's the risk in the wheat market? Why don't you start, Scotty?
Today, obviously, the first risks that I see are weather related here to the U.S. crop. We went into dormancy in really, really good condition, great shape. I mean, we started out, that first report at the end of October was the second worst on record, and we ended up at 55%, good to excellent. So we're looking pretty good right now, but the risks going forward are going to be winter kill, anything from a cold variety. And then as we get out into March, obviously it's always, the question is going to be precipitation. What type of moisture do we put on this crop to finish? So that's going to be the big thing there. What's it going to look like across Europe? We should have a bit of a rebound in the crop in Europe. Ukraine probably holds serve. I mentioned before that Russia is going to be smaller, likely. And so in the world, I don't think we're going to, we're going to make a record production this year by the skin of our teeth. And we probably hold serve into the next year, I think. Depending on what we get out of Australia and Argentina right now. So that's the big risk I see on from that standpoint. The war we've talked about, it's kind of been a bit of a false signal here as of late. So
yeah, not making light of the war, but I mean, from a price input standpoint, it's almost like the wheat market has gotten tired of talking about it.
Yeah,
honestly. The thing that, when you look at the wheat market and it's in your wheat deck, and to me, it's the slide that whaps me in the face the hardest. It is that combined between exports of wheat with Russia and Ukraine.
Yeah.
And if you look at it, we are setting record exports out of Russia and the Ukraine for wheat in the middle of this war. And that is the one thing that nobody that I'm aware of would have given you great odds of that not happening. I never would have guessed that in a million years, 2 or 3 years ago when all this stuff started. But somehow those wheat exports have continued. And I think that's been the biggest surprise, really, to the wheat market. I think when you look at the spring planted crops, the oil seeds, certainly the corn market, we got weather risk still in the windshield in South America, although we're coming down the home stretch in central Brazil. That's certainly part of it. We've got this acreage thing that we talked about next year. To me, especially when you get into the veg oil side, which certainly affects the whole soy complex, you got a lot of policy stuff here that could certainly whipsaw markets around. And then of course you got the North American growing season right on the heels of that. But that's how I would kind of, at least chronologically, assess risk in those markets. You got anything to add on to that one?
I think that we're going to start off out of the gate with smaller crops for wheat, and we're going to have a retreat back to trend yields and probably maybe a 1% increase. So I think we'll be looking at a
production. Your 1%.
1% increase in wheat planted acreage and a 9% decrease in production, because we're going to fall back to trend yield. So it'll be a little bit tighter balance sheet, and you could start to drum up some nervousness, I suppose, in the corn if you don't have much of an increase in acreage. I mean, we're going to be following a year when we had yields 6 bushels per acre above
Right.
trend. And when you retreat back 6 bushels per acre, that's
You
about
better plant more
500
acres.
million bushels. So yeah, it's not, this may be, we're living in the land of plenty right now, and it may not be as much
Mhm.
by the time we get to the last half of 2025.
Yeah, that's a great call out. I agree with you. Corn's probably going to be more reactive to adverse changes in South American weather, probably more quickly than the soy complex would, because that is the one thing that we do seem to have plenty of right now is soybeans. So
Yes.
at any rate,
Yeah.
well, we have gone pretty long here. Anybody in the audience, anybody that's listening here, have any questions?
Questions?
There was
any-
one comment Amy threw a in the box there. She threw in that HPI has impacted broilers in Alabama this week, so we probably should keep an eye
Oh.
on that. So
Yeah, wonder if that's probably not, at least at this point, not significant from a total standpoint. Certainly something to keep an eye on.
no,
Certainly something to keep an eye on. Your chicken sandwiches getting more expensive. That would be bad. That would be bad. All right. Well, we certainly appreciate everybody tuning in here. This will be available on our YouTube channel here if you know anybody else that's interested in it. And as we always say in the commodity business, be careful out there.
Merry Christmas.
Yeah, Merry Christmas. I should
Christmas.
have added that in.